Okay, so I'm going to be going over a couple things in this video, including Fibonacci, because a lot of you still seem to struggle with market structure, Fibonacci, things like that, and keeping your charts clean. So I'm going to be going over keeping the charts clean, because a lot of you seem to have extremely cluttered charts, and it's just every time you send me a screenshot of that cluttered chart, it hurts my eyes, if I can explain that other way. Anyways, so the main areas of support and resistance you want to have is one, your key levels, your main key levels being your monthly support and resistance, right? If you notice, if you just simply zoom out, once the market does reach one of these areas, there could be consolidation in that area and rejection. Normally, as you could see from here, we were near the previous key level up here. We didn't quite reach there yet, but as you can see, when price did reach 114,737, there was a strong rejection there. And then when price came down to the next key level, 111,068, it went right back up to this orange zone that I have. So you got to pay attention to your key levels and see how they work. You got to back test things. I can't really explain how important back testing is, but overall, as you can see, it consolidated in the key level, ended up breaking, came back up and retested. That's when you would have pretty much got in on this retest here for that monthly key level. It's just fairly simple. As you can see, consolidation, then rejection of support. Now, obviously, you want to draw the medians of things. So, I'd probably say the median, a nice median would be right here. And then you'd want to see how the monthly candle closes once those do close. And then as you can see, once it rejected this key level, it pushed back up to the next key level. So, these are just mainly for higher time frames. This is on the 4 hour. You could be looking at this on the daily or the weekly time frame. I'll do that. Like I said, you could be looking at this on the daily or weekly time frame. Now, keeping the charts clear. So I mainly trade based off the 4 hour time frame. So when you're setting up support and resistance based off of the 4 hour, you want to be on the candlestick, or my apologies, the line chart. And you want to look for the major areas of reversal. So I've pretty much marked off these areas, right? Keeping my chart clean. So you can see it kind of gapped this area and completely rejected it. Now, how you could have taken advantage of this? Well, there's a couple of ways. Just because it rejected this area doesn't mean, there's a change in trend, right? Keep that in mind. The market is still uptrending. We could do a couple of things here. First of all, we could draw a trend line, let's say from higher low point to higher low point. Right, we could draw that trend line there, Fibonacci as well. I'm going to go over that in a second. So, as you can see, I have my main key areas here. Now, if the market were to break this one, then I would zoom out, go back on the line chart, and look for other key areas in the past that the market could possibly, reject. Right, you want to be marking these things down. So, as well, if the market were to break here, then I'd go back in the past and mark off some more key levels as I'm deleting the top ones. Keeping the chart clean. I normally, as you can see, the market right now is moving sideways. It's consolidating. It's not a really big issue. The market's not in a perfect trend, right? So I like to keep, support and resistance kind of to a minimum, pretty much to where the most important areas are. So overall, now when you're doing support and resistance based off the hour time frame, right, if you're more of a day trader and you base your support and resistance off the hour time frame, then you're actually going to be doing the opposite. You're going to be on the candlestick chart, and you're going to be pretty much looking for the medians of the wicks, looking for the most wick touches. So I'd say right here is a pretty nice area. As you can see, here we have support, here we have resistance, here we have resistance again, here we have support as well. Want to be finding the median areas. So I'll do another one. I would say right here would be another nice area as well. Maybe drag this down a little bit. Yeah, right here would be a nice area as well. As you can see, now it kind of came down. Once it broke this support, retested it, rejected it, came back up to it, or retested, broke support, retested it, became resistance, rejected it, then came back up to resistance. This would have been 100% retracement if I'm not correct. Pull fibs. Now, when the market is actually downtrending, this would actually be considered a break of structure, because here's a previous higher low point, here's a low point, and the market broke the previous low. So this would actually right here be a break of structure on the hour time frame. Now, you got to keep in mind each time frame has its own trend, each time frame has its own structure point. So this being the previous high, this being a lower low, that's where you would pull your fibs from. So bearish candle wick to bearish candle wick. So as you can see, the market did come up to about that 38.20, but it did test on the 26th. So the 23.60, you know, it being that unbalanced zone, definitely. I'm gonna break this down to the 30-minute time frame just to get some more detail. So I would actually consider this to be a 23 continuation because I didn't see a candle come and at least touch this area. So this would actually be a 23 continuation level, and that does not count as a lower high or a higher low point. So then I'd actually drag it to the next lower low before the market pulled back significantly. As you can see, that was at 61.88. That's what I'm talking about, Confluence. This is how I caught this entire move here, Confluence. So when the market actually did push up to this area of resistance, you know, all you have to do is wait for the reversal pattern. So since we're on the hour time frame, I'm actually going to highlight this tested candle and see what information we can get out of it, because you got to keep in mind each candlestick tells a different story. So now I'm actually going to go to the 15-minute and see what information I can get from this time frame. So on the 15-minute time frame, we came up to about that 61.80 area, formed resistance here, completely rejected it, and I probably, you know, definitely I wouldn't have gone in based off of this. Let's look at the moving averages. Yeah, I wouldn't have gone in based off of this just because moving averages, you know, aren't crossed on the lower time frames. I at least wait for them to cross on the lower time frames. So here I actually would have gone in based off of this candlestick here, right? Once it closed tested on that area of resistance, I actually would have gone in. So now before you get in on an order, you know, you want your risk to be a lot smaller than your potential reward. Notice that I said potential reward, because we can control our risk. We can control how much we're going to lose, but we can't control how much we're going to make, right? So since I'm basing this trade off of the hour time frame and I'm entering right here based off of this 61.80, I'm going to have my stop loss above the previous market structure point. So this being a higher low point or a lower high point at this area of resistance, I'm confident enough that the market is not going to break this resistance and it's going to go in my direction. So now I'm looking at one of two things, right? How much am I going to risk this trade? The most I'm ever going to risk in a trade is about 5%. That's the most I'll ever risk, and that's me trying to grow an account. So you also have to keep one thing in mind. You want your winners to be a lot bigger than your losing trades, right? You could have panicked right here and close this trade at 23 pips, but look at your risk. You know, why would I enter? You know, think about it like this. Why would I risk $100 to make $100? It doesn't make sense. It makes more sense for me to risk $100 to make $200 or $300, right? So if I'm entering this trade, I'm looking for at least a 1 or a 2-to-1 risk reward, meaning I'm going to be getting 2 times my risk, right? I'm going to be gaining 2 times my risk. And you can only do a 2-to-1 risk reward ratio when you have a 50% win loss or more. What I mean by that, meaning you win 50% of your trades, right? So in a block of 10 trades, you win 5, you lose 5, right? You can only do that if a 2-to-1 risk reward ratio if you have a 50% win loss. So if you had like a 40% win loss or a 30% win loss ratio, then you'd probably have to be only entering trades that will give you a 3-to-1 risk reward ratio, and you will be profitable, right? Because the thing about Forex is it doesn't matter if you're right or wrong. We're going to be wrong at times. We're going to be right at times. What matters is how you manage your risk. That is the only way you will become profitable and consistent, by managing your risk, right? If I have an $1,000 account and I'm risking 20 pips, there's no way in hell I would even think about throwing a standard lot, right? So, you know, that just goes down to you, how much you're going to risk. If you're trying to grow an account, you know, probably like 3 to 5%, you know, would be a little bit more on the riskier side, but you know, you are gaining a little more. So in this case, right, I'm looking for a take profit either at the -27 or the -61.80. You know, you could also take profit at the 0 as well, because, right, we're way past that 2-to-1 risk reward ratio. Currently, this would have been a 2 to 0.32, meaning, of course, you're going to be getting 2% more than your risk, more than you're risking. So you definitely could have closed at this 0 here, right? If you're a little more conservative, right? But me personally, I would have waited until this extension level, at least here. So as you can see now, this is a 3-to-1 risk reward ratio, right? Or a 3.55 if you want to be more mathematical about it, right? So I'm getting 3 times my risk. Now, obviously from my entry, right, you're going to hold your order until you get stopped out. You're not going to close just because, right, let's say I entered right here at this candlestick and I see this bullish candle form, right? You know, your emotions could be going a little bit crazier. So that's why you always have to hold until you get stopped out by your stop loss. Because, I easily could have closed here and then would have seen this and then would have entered here and then I just have a bigger risk. And that's not how you want to be trading. You put a stop loss there for a reason, right? Why would you close any time earlier than that? It just doesn't make any sense to me. You have to let your trades ride out. And you also can't move your stop loss to break even too early too. Like, just because you see this big ass bearish engulfing candlestick doesn't mean you're going to be automatically, move the break even risk free. No, that doesn't make sense. You have to give the market room to breathe, right? So once this candle closed, I definitely would have held the order there. We have across the moving averages. And then, once it broke under that 38.20, came back up, another bearish engulfing candlestick, and I pretty much would have held the order probably till around here. It being the negative 27 and the market started consolidating, I definitely closed my order in this area. So you can see, I'm getting 3 times my risk, right? I'm getting 3 times my risk. So that was a great trade. So that's pretty much how you would do that. So yet again, like I said, you want to base your support and resistance on the hour time frame based off the most wick touches, right? So that's how you would pretty much clean up your chart, set up support and resistance, yada yada. So now pretty much now I'm going to break down UJ and my thoughts. So currently, as you can see, we have one of 2 things that is happening. The market is still uptrending, right? We're making higher highs, higher lows. Simple. We could draw a trend line. Bullish candle wick to bullish candle wick. Now, when you're drawing a trend line, first of all, we're still in the buy zone. Second of all, when you're drawing a trend line, you have to be able to, quote unquote, walk on the trend line. Meaning it can't be, like, this can't be a trend line. Like, what the fuck is that? Like, that's... It just doesn't make any sense. That pullback wasn't significant enough for it to actually be considered a higher low, right? So then point A to point B, right? Then we could use our fibs. Now in an uptrend, here we have a previous higher low point. So point A, point B, right? Bullish candle, in this case it'd be bullish candle wick to bullish candlestick body because there's no actual wick. So yeah, so then in this case, the market did come down to that 61.80 area from this double bottom here and then went right back up. As you can see, we have hit H4 resistance. So what I'm looking at now is here is a previous higher low point as well. You could consider this as a high. Definitely, you could consider that as a high. Then you can have your point A, point B here based off the daily time frame. And as you can see, this was a 61.80, and this could definitely be a high. So you can see the market's kind of transitioning, kind of forming lower highs. So here we have a higher high. Then this high was definitely lower than this high. And this high was definitely lower than that high. Right? You have to look at both sides of the market and build a bias. Right? So now, as you can see here, we have across the moving averages, red over blue. So I'm going to be marking this off. Right? So I'm going to give you kind of my analysis as to where the Japanese yen and the US dollar is heading, or the US dollar and Japanese yen, UJ. So now going to the 4-hour time frame, clearly the market was uptrending here. So here we do have a previous higher low point, right? We want to measure that. Point A, point B, bullish candle wick. So in this case, bullish candle to bullish candle wick, because there's no wick. As you can see, it came back down to that 50% area. This zone being unbalanced, it luckily did reject and went right back to my extension levels, my take profit area. So yes, this would be considered a higher high, right? So now we're going to do the next step, right? Here's a previous higher low point, point A, point B. Okay, so here being the current higher high, right? One of 2 things could happen, right? I'm assuming it could come down to the negative 61.80 since there is previous market structure and there is support here based off the hour time frame, right? We could consolidate here and then reject that area, hitting the extension levels being the negative 27 and the negative 61.80, maybe even push up to 115 based off the daily Fibonacci. So point A, point B, 115 above this key level here based off the daily fib. So now going to the 4-hour time frame, the market structure breaks if it breaks 110%. So if it breaks pretty much 100 right here, then that would be a break of structure. That'd also be a break of support, and that would be the break of the trend line, and that would be the break of the trend, right? So I'm not going to be looking for any sell opportunities until that happens. I'm going to be following the trend. I'm not going to be going against it. Right now, the market is uptrending, forming higher highs and higher lows. Sure, you know, this could be a double top, but it can also easily just come back down to this area and completely reject it, right? We're not trying to predict what the market's going to do, right? Because I could easily say, oh yeah, guys, you know, double top right here, you know, it's going to break this support, come back up, retest, and that's when I'll get in on the sell. You know, that's 100% possible, but overall the market's still uptrending because we have a higher low, you know, we're just forming highs and higher lows. So then at the same time, you know, finding this meaning area, this could be, I believe it's called a rising wedge. So that could be another market structure pattern there as well. You just want to be thinking about all the possibilities and just build your bias. I don't counter trend. I'm not going to go against the trend. There's no point. It's kind of like, why are you buying in a seller's market and why are you selling in a buyer's market? It just doesn't make any sense, right? All I know is that once I do enter, I'm going to manage my risk properly, and that's how I stay profitable, by managing my risk. So now, like I said before, you know, this is my current setup, point A, point B here. You know, we do have rejection of this area of resistance. Yeah, definitely, you know, if I would have seen this forming, I would have taken it, but I wasn't home at the time, so I wasn't able to take this sell opportunity here, you know, catch a couple pips. Yes, I just contradicted myself. That's counter trending, yes. But overall, I'm trying to give you guys the example to pretty much follow the trend. But, you know, I only counter trend when I'm day trading, meaning I'm not going for a big move. I'm going for, you know, smaller pips, but I'm still looking for that 1 to 3, 3 to 1, 2 to 1 risk reward ratio, right? It's just smaller pips. So in this case, let's say if I would have entered here, which you could have taken the sell opportunity, you know, we already have cross moving averages. Here we have that previous area of support. As you can see, it broke under, they came back up and retested it. Now we could pull out Fibonacci from here, you know, point A, point B right here. You know, if you put it from here to here, yeah, 38.20 right at the area of support, bearish engulfing. And let's look at the smaller time frames. Yeah, so I definitely would have entered right here. Right here. So initially I wouldn't have entered here just because of moving averages and the market's uptrending, but once this happened and then this happened and then this happened, I would definitely would have entered after this bearish engulfing. Now let's look at risk reward, right? So point A to point B. So then, you know, entry right here. So we're looking at about a 14 pip stop loss for a 20 pip reward potentially, or a potential 46 pip reward. So, you know, definitely, you know, very close to a 2 to 1 risk reward ratio. Right now it would be considered a 2 to 1. I honestly don't know if I would have taken the trade, just because it could have hit the negative 27, but it also couldn't have. Actually, yeah, I definitely would have gone in on this. Nice push. It would be a 2 to 1, you know, holding to that negative 61.80 right to the next support or key support for the hour time frame, you know. So like I said again, you know, I am expecting the market to come down to that area of support. So that's pretty much how you could have gone in based off of that, you know, small counter trend. That would have been a nice little intraday trade. Like I said again, you know, I am expecting the market to come back down to at least here. And if it does come down here, one or two things are going to happen. It's going to either break this support and continue going down to 100%, right? If it breaks 61.80, then I'm expecting 78. If it breaks 78, then I'm expecting 88. If it breaks 88, then I'm most likely expecting a break of structure on that 4-hour time frame. So it's all about patience now and waiting to see what the market's actually going to do. So hopefully you did gain a little bit of, you know, knowledge off of this video, a little bit of value. And yeah, I will be talking to you guys in the next video.